Right, good afternoon everyone. My name's Jason Wilde, National Sales Manager at Paragon Bank. So you can probably see from that today, we're talking about HMOs. So strap yourself in, because it's exciting. If you can pick up the sarcasm there. So for today, we're going to be covering various different factors on HMOs. So first of all, looking at the licensing, covering the basic requirements there. Planning permission, which is something that crops up on a very, very regular basis. So I'm just going to kind of give you a bit of an overview on that side. We're going to look at the difference between licensing and planning, which you may be surprised that they don't often talk to each other, and there is a certain difference between the two. I want to touch on Article 4, which is something that's been implemented in various areas, and how that can impact any applications you're submitting, and what can be done to smooth the transaction through. And finally, looking at investment valuations, their use, why they're used, where they're used, and the different factors that surveyors are looking at. So as a lender, we see a wide variety of HMOs. We see the good stuff, but we also see the bad stuff. This particular property was actually let, so bear in mind it did have a HMO license, so you can only assume what condition it was when it was originally let, but once you've had 4 or 5 different tenants move through properties, they can deteriorate fairly quickly on that side. But one of the most common questions that we're asked as a lender: do you require a HMO license on this property? Now, for a lender, it's not our place to say, yes, we do require a HMO license, or no, we don't. It comes down to that local authority. You've got 2 different licensing when it comes down to HMOs. First of all, you've got mandatory licensing. This is black or white. If you've got 5 or more tenants, you need a mandatory HMO license. There's no way of getting around that. What you've also got, though, is additional licensing, and this has been brought in certain areas, and generally it's brought in to control the number of HMOs in particular roads or particular areas, where effectively the local authority can make their own rules up and say, we know the standard is 5, but we're going to say, actually, if you've got 3 unrelated tenants in this property, you're going to need an additional license in place. So that will vary across the country, and equally, in certain areas, different wards, different towns and different cities, it will vary on that side of things. You've also got selective licensing, which is not restricted just to HMOs. And selective licensing, I believe, is in place in Manchester, where it's effectively saying it doesn't matter if it's a 1-bed flat, you need a license as a landlord to let that particular property. So the types of things that they're looking at when they're looking at whether they're going to issue a HMO license or not, it's all fairly kind of standard stuff, but just to kind of cap over it, they are looking at the condition of the property. First of all, and I think it's only right, they're making sure the property is safe. It's safe for individuals, for families to be living in the property. There's no damp, anything like that. Electrics are all suited. Looking at room sizes, which we drill down on in a couple of extra slides, giving you an overview on the actual room sizes. But what we find from a landlord's point of view is, when they buy property, they convert through to HMOs, some of their views are, I need to get as many rooms as possible out of this property. And you understand why potentially you're going to generate more rent, but obviously there are certain restrictions available there. So also look at things like storage. So we're not just talking about storage for the tenants in terms of their own personal belongings or in the kitchens. You're talking about things like bin storage. You're talking about things like, if they've got bikes or even if they've got cars, where they're going to be parked, etc. Cooking facilities, again, you're talking the real basics of modern life, effectively, that there is adequate cooking facilities, and most importantly, adequate washing facilities for tenants. Again, you're talking about very, very basic requirements here, but it's just kind of an overview on the types of things that they look at from a HMO licensing point of view. So they also carry out a fit and proper persons test on the landlords, so just checking, and they're carrying out criminal record checks. So they're not going to eliminate everyone, but just to make sure that the landlord's as fit and proper as they can get on that side. The cost could be up to £1,000. Again, this varies. You might find one local authority might be £400 or £500. The next one might be £950 in terms of that. The actual fine for not having a HMO licence in place, I believe, is upwards of £30,000. And as well as that, my understanding is that you can actually claw back the rent, so you can be asked to pay back the rent for at least 12 months. So what we're finding is that, with the emergence of social media and stuff, certainly in a lot of student areas, students are actually cottoning onto this, and they're actually checking whether or not the student property they're in needs a licence. If it does need a licence and it hasn't got a licence, there are claims going through now for them to recall back some of their rent that's obviously been paying over. Which is only right, because let's be fair, having a HMO licensed property means that it has passed the basic requirements of that. And I think it's only fair that if you're a tenant and you're living in a property, you're paying rent, that the landlord's gone down the route of obviously making sure it's as safe as possible on that side. The last bit there, licensing the landlord's name. Now, from a lender's point of view, makes no difference whether or not it's in the personal name, whether or not it's in the name of a limited company. Makes absolutely no difference whatsoever. But if I'm a landlord and I have my letting agent's name in there, that's all very well until I want to change letting agent. Then you're obviously potentially looking at changing your HMO license. So in terms of the requirements, you've probably seen these floor sizes there. You've got the single occupancy and your double occupancy rooms. Doesn't normally include the en-suites. But one of the key things that you look at on the right-hand side is the ceiling space. So we occasionally see properties where it comes into us, it comes in as, say, a 6-bed HMO. Surveyor comes back and they've actually valued it as a 5-bed HMO. And then when we're drilling down a little bit further, they're saying, well, actually, one of the rooms is up in the loft. So the actual floor space itself might be in excess of 6.52 square metres, but I can't take all of that into account because I haven't got that clearance space of 1.5 metres. So again, it's sometimes if you do see anomalies on valuation reports, sometimes there are comments regarding that on there. Again, we're talking basic requirements here, and I think, modern day society, it seems a bit wrong that we're saying, look, you need at least one cupboard per tenant, which seems a little bit strange. One sink for up to 5 people, doesn't particularly sound massively appealing, or 2 sinks for 6+ people. We're talking about the basic requirements here, and we are finding that more and more landlords now aren't taking the view that that's the basic requirement, I'm going to go in at that level. Right, that's what it needs to be, but if I go in higher, I can provide more facilities for the tenants, better quality fittings, etc. I'm more likely to get a higher rent, but equally I'm likely to get less void periods going forward. So there's also single occupancy living rooms. So again, we're often asked the question of, do you require a communal space? And again, with that, it's not down to us as a lender to say, yes, we do require it. But the view that's coming across from a lot of local authorities is that if you have a bedroom which is 10.22 square metres, it's actually classed as being a living space. So again, it's not a particularly big room, but it's actually viewed that you can have your bed in there, your furniture, but you've still equally got space to move around. So it's actually classed as being a living space. So rooms of that size aren't necessarily going to be required to have a communal space. What we will generally tend to find, the communal area will be a larger kitchen, so a large sort of kitchen diner. But again, with that, it's not down to us as a lender or for lenders in general to decide that. We should really just be guided by the local authority and the planning department. So again, basic requirements of what's required. I guess a lot of this may well ring true to some of your clients. Fire detectors and alarms, emergency lighting, escape routes for tenants, and fire doors and smoke seals. Now, a question that we're often asked is, I've got a client who's looking at buying a property, they want to convert it through to a HMO, what do they need to do? And the answer for us is to duck that question and say what they need to do is pick the phone up and they need to speak to the HMO licensing department. They need to get an overview on exactly what that licensing offer is going to be expecting. There's an absolute minimum in that property for them to grant the HMO license. So in terms of planning permission and how it works, I'm just going to cover how buildings are categorised in the UK kind of going forward. So you find your standard residential property is classed as C3. Now, to let a property as a small HMO, you change of use under C4. Now, under permitted development rights, you can do that without the required planning permission. You could effectively just choose to let your property as a small HMO. Change of use is relatively kind of straightforward. You've also then got, I don't know if anyone's come across this, sui generis planning. This is for your larger HMOs or those types of properties that can't be classed as your standard kind of residential stuff. We did have a scenario, wasn't so long ago, where a broker rung up in tears of laughter, I might add, because they had a case similar to this, and the borrower had rung up and said, have you got an email for sui generis, because I need to speak to him about my planning. So it's an interesting one. So it's kind of one that we find that borrowers aren't necessarily aware of. And where a lot of this stuff comes out, we assume it's in place, surveyor assumes it's in place, everyone assumes it's in place until it comes to the legals, and a week or so before completion, solicitor will say, we haven't got the required planning permission in place. It's not the end of the world, but what it does do is it certainly adds a delay to the application going forward. So I touched on licensing and planning earlier, and you'd be forgiven for thinking that the mere fact that you've got a HMO license means that you've got the planning. Unfortunately, it doesn't work that way. We see multiple examples of properties that have HMO licenses but haven't got the required planning in place. It's quite concerning when you consider most of these apartments are in the same building. Down in Milton Keynes, I think they're actually on the same floor, but invariably they don't talk to each other. Our understanding is they are starting to communicate a little bit more kind of going forward, hopefully with the end view that they would only issue a HMO license if they knew the correct planning was in place. But it's quite frustrating, and again, a lot of this stuff comes out post-offer, pre-completion, and sometimes the landlords are under the impression, just because I've got a HMO license, of course I must have the correct planning permission, and it's certainly not always the case. So licensing's by the private housing department, planning permission obviously by the planning department. And the types of things that we're looking at, we've already covered some of the stuff regarding HMO licensing, what they're looking at. So you're looking at room spaces, amenities, obviously safety of the property. The planning, looking at things like the parking, bin storage, sort of bike storage, anything that kind of goes with those as well. Use this example here that we saw as case exactly the same as this. So clients had a HMO, small HMO, which they converted from C3, so residential, to C4. They then let that as a small HMO for 20 odd years. For some reason, and I don't know why you would go down this route, they then opted to let that property on a single family occupancy, a period of 6 months' time. Now, what solicitors confirmed to us as part of this one, they may have had the C4 planning, but the mere fact that they've now let this as a single dwelling, they've now lost their C4 planning. So they're now back to square one. They're now back to this property being classed as a C3. Not necessarily the end of the world, because if they want to let that as a HMO going forward, obviously, provided they're not in Article 4, they can convert that through to a C4 planning. But the issue with this one was Article 4 was then in place, which we're going to cover kind of going forward. So the mere fact that that property had a HMO licence and it had the correct change of use on it, the fact that they'd let that out on a separate basis to a family for 6 months' time means that they actually lost that original planning. So again, with this comes up probably 2 or 3 days before completion, and it just causes all sorts of problems. You can get around it, but again, time is of the essence often with things like this. So in terms of Article 4, I'm sure that you've come across it. My understanding is that in Manchester, and someone may correct me here, I think it's been in place since 8th of October 2011, I believe. And effectively what that's saying is that if you take the previous slide where we were talking about where you've got your standard residential properties, C3 class, I could then let one or convert that through to a HMO, change that through to a C4 class, small HMO under permitted development rights. The moment Article 4 is implemented, you cannot do that. You need to apply for planning permission. So again, where this now causes problems is not necessarily the fact of Article 4's in, but what you find is that clients who are looking at refinancing properties, again, to use an example in Manchester, someone's refinancing a property that's let as a HMO, has been let as a HMO prior to the 8th of October 2011. When it gets through to completion stage, the solicitors, which is on my next slide. I don't know if you probably can't read that at the back in terms of the valuation, but that's extract taken from valuation report, where surveyors said property is located in an area where local planning has revoked the permitted development rights between classes of C3 and C4 by way of an Article 4. As such, the solicitor acting must provide documentation to confirm the property has planning consents for its current use. So historically, if you kind of go back pre-GDPR kind of time, we used to find that a lot of landlords used to have historic tenancy agreements, used to keep those on file. And if they could drop an AST down that showed that it was let out to 4 or 5 individuals prior to that Article 4 being implemented, it's fine. You'll probably find that most lenders are perfectly fine to do that. The issue we're finding now is that with historic Article 4s, like in Manchester from 2011, certainly with GDPR, it's very unlikely that anyone's going to have access to that type of information. So a couple of options that you've got. We've got around this in various different scenarios. We've had an email from the local authority who just kindly basically confirmed that the property, they can confirm it was let as a HMO prior to their implementation date. We found Rightmove listings that shows that the property was listed as a HMO. Again, with this, not going back to 2011, but in certain areas where they've, I think, Birmingham, for example, I think Article 4 came in 2020, so you can still find historic Rightmove listings. But equally, in the absence of all of those, then you're kind of left with a situation with the certificate of lawfulness, which again is not the end of the world. You're talking £300, £400, maybe £500. It's not cheap, but it's not normally enough that will make or break the deal. But time, again, is of the essence of this. They're trying to get one of these, when it's flagged up 3-4 days before completion, you're looking at 4, 5, 6, maybe 7 weeks to get one of those in place. So the only advice that I would kind of offer is if you have clients and you know that they've got HMOs and you know they've got HMOs in areas where or the landlord knows that there are Article 4s. Bear in mind, a lot of landlords, certainly well-established landlords, haven't been refinancing over the last couple of years because they've been on nice low reversion rates. But obviously with the increase in rates going forward, we're finding more and more of these landlords coming away from their reversion rates looking to fix. So in the absence of having any of that information, they will need to future-proof their HMO properties. So whether you've got clients who are looking at refinancing now, 6 months' time, or potentially a year down the line, if you're in communication with them, perhaps carrying out portfolio reviews, from my point of view, I don't think it's a bad thing to bring up and say, look, at some point, this will rear. If you know the property's in an area of Article 4, is it the end of the world if they go down the route and try and find historic ASTs, try and see if they can get an email from the local authority or go down the route of getting a certificate of lawfulness. If they can get that now, what it does is it future-proofs their HMO, and it effectively should open the door to absolutely every single lender going forward. So investment valuations, we're often asked a question regarding investment valuations, and more often than not, the call we get is that the client's adamant they want an investment valuation. And more often than not, we assume that's on the basis that they think it's a lot higher than what the actual capital value is. But we do find it's not always the case. And there's certain areas where I'm living at the moment, Cambridge, you're not always guaranteed an investment valuation will be higher than the bricks and mortar value. So there are certain areas where it doesn't always work in the landlord's favour. But we've kind of just, we spoke to the group surveyor who heads up our surveying department, a guy called David Hitches, who co-wrote the paper on investment valuations. So I spent a bit of time with him kind of working through. I could cut the next 5 minutes out by saying it's valuer's comments, because that's ultimately down to the valuer to decide. But to try and get an idea on the types of things that they're looking at. So first of all, looking at location of the property. You've got a property in the middle of nowhere, and it might be let out to 4 individuals, and you want an investment valuation, forget it. It's never going to work. There's never going to be a sustainable marketplace for that property going forward. Again, number of bedrooms. You've got a 3-bed, red brick terrace house. In a standard residential road, it might have to be let out to 3 individuals. If you expect an investment valuation on it, it's never going to happen. You're not going to get that on that side of things. Positive things like amendments to the properties. If someone's gone in, perhaps sort of, en suites or individual, sort of bathroom, washing facilities in their rooms, etc., that's a massive positive. And, effectively you're looking at adjustments to that property to make it more suitable and more appealing for multi-let occupation. Tenant demand as well. I don't know if anyone knows Nottingham very well, but you've got Lenton Boulevard there, which is a huge long road. One area of Lenton Boulevard, very, very popular with students. You go down the other end, yeah, it's still the same road, but it's quite a distance from the actual campus. So the further away you get from the campus there, the less likely you are to get an investment valuation on the back of that. They're also looking at investor demand. So the property comes in. We as a lender value it up, value an investment valuation, complete on the mortgage, the borrower stops paying, the lender takes that property into possession. The lender's looking at disposing of that property. Who's it likely to appeal to? Is it likely to appeal to investors? If it's in student land, it's highly likely to appeal to investors looking at buying a ready-made concern. But equally, if it's in a standard residential road, you may well find that appealing to more residential occupiers. And if it does, you're then less likely to end up with investment valuation. And some of the factors they look at, and I say this with I say a pinch of salt. I'll probably use about a ton of salt when I say this, is that the amount of investment valuations that I've seen that have finished somewhere between 8 and 12 times the annual gross rent is very, very high. I'd say probably well over 90% investment valuations finish up around that figure. The only reason why I bring that particular figure up now is that, if you are speaking to clients, where we tend to find this happens, you've got a client who's converted a property through to a HMO, they spoke to their letting agent or they spoke to their estate agent who's put a potential figure on it. And, if I've had an inquiry come through, £50,000 worth of rent per year, and the borrower's expecting it to value up about 1.2 million, you're pretty much trying to manage your expectations and saying, look, it's unlikely to. I can't guarantee it won't, but it's unlikely to based on the way they go. So again, some of the things that they look at when they're capitalising that rent, so they're looking at the tenant profile. If you're looking at students, yeah, that's fine. If you're looking at professionals, but equally if you're looking at social tenants, they're perhaps paying slightly under the market rent on that side. The cost of utilities is also taken into account, and I think kind of, we're moving into a different era now, certainly with some of the student lets and the professional marketplace where it's no longer acceptable just to have a broadband line. It's got to be super fast fibre broadband, flat TVs in the room, flat screen TVs, Sky TV, etc. All of those are additional costs to the landlord. And that's taken into account when the surveyor's actually looking at coming back with their final valuation period. Voids as well. How likely is the property to be empty for any period of time going forward? Is there seasonal workers? Are you looking potentially out of season, going to be low demand, etc.? They will factor that into account when they're coming to their investment valuation figures. They also look at ongoing maintenance at the moment. So how much is required at the moment? Is it, like tip-top condition, or is it always going to need patching up going forward? What we will generally tend to find with HMOs is that as and when tenants move out, they kind of need a bit of sprucing up the individual room. That, if a tenant's been there maybe for a year or two, it kind of needs to go in, new carpets, kind of painted, a general kind of spruce up. Again, it's not necessarily something that will break the deal, but surveyors are looking at how often are these tenants going to change kind of going forward, because again, that's an additional cost. And again, maintenance going forward, again, an old Victorian house that, potentially at some point, renders, going to need doing or a replacement roof. Again, they will look at all of those factors when they're working out their final investment valuation figure. It's not an exact science, and it certainly isn't a 8 or a 10 times or a 12 times, but somewhere in that kind of region is generally where I've seen a lot of HMO investment valuation come back. And as a lender, and I think pretty much most lenders who do offer investment valuations, you can normally get a fairly good steer by referring it up front and say, look, this is where it is, this is what it is, and we can normally stick it under those as a surveyor who give us an idea. But surveyors, to be fair to them, will often then caveat this and say, look, until I get out there, until I look at the full setup, I can't be 100% sure, but based on where it is, the fact it might be an 8 or a 9 or a 10-bed HMO, I think the larger the property you've got, the more adaptations you've got, and the more stable the rental market is and sustainable the rental market is going forward, the more likely you are to get an investment valuation. And that finishes us on HMOs. Like I say, I'm sure it's not for everyone, but hopefully there's a couple of bits in there. I think the main thing from my point of view is to take away some of that stuff regarding the planning and that C3 to C4 and equally your Article 4 stuff, because that's the stuff that really does start to bite home pre-completion, and it causes, I'm sure yourselves, an awful lot of stress. When you've got someone who's expecting to draw down funds and they're unable to because of planning, because everyone assumes it's there. We've had stuff where the estate agents have told the buyer that the planning is all there. Everyone assumes it's all there until solicitor confirms it's not. So hopefully that's the one thing you can take away from this.